Why everything is becoming harder to insure. Most people only think about insurance when something goes wrong. A flood, a fire, a car accident, a hospital bill, a storm, a canceled trip, a damaged business, a home that cannot be rebuilt without help. But insurance is much bigger than a policy. It is one of the hidden systems that allows modern life to function. It helps people buy homes. It helps banks lend money. It helps businesses take risks. It helps ships move goods across oceans. It helps hospitals, factories, airlines, landlords, families, and governments absorb shocks that would otherwise be impossible to carry alone. Insurance is not just about disaster. It is about confidence. It tells a household, you can recover. It tells a bank, this mortgage has protection behind it. It tells a business, you can operate, hire, build, and invest. It tells a society, when something breaks, not everything has to collapse. But around the world, that system is under pressure. In parts of the United States, homeowners are asking why protection is becoming harder to afford. In the UK, storms and floods are pushing claims into household budgets. In Germany, heavy rain and natural hazard cover have become a national debate. In India, more people are building wealth, buying vehicles, homes, healthcare, and financial products. But the question remains, how much of that new wealth is actually protected? And in Singapore, a dense, high-value, globally connected city, insurance is part of a wider resilience system. Property, health, travel, cyber, climate, business continuity, and financial confidence. The question is no longer only, do you have insurance? The deeper question is, what risks are you still carrying yourself? Because when insurance becomes more expensive, more selective, or unavailable, the risk does not disappear. It moves. To the household, to the landlord, to the bank, to the employer, to the government, or to the community. And that is why insurance may become one of the most important hidden systems of the next decade. To understand why, we first need to understand what insurance really does. What insurance really is. Insurance can look boring from the outside. A document, a premium, a monthly payment, a clause nobody reads until something goes wrong. But underneath, insurance is a machine for moving risk. One person cannot easily carry the cost of a house fire. One family cannot easily carry the cost of a major medical event. One small business cannot easily carry the cost of a flood, a cyber attack, or months of interrupted operations. So insurance pools many risks together. Many people pay a smaller amount so that a few people can receive a much larger amount when loss happens. That is the simple idea. But the modern insurance system is much more complex than that. It depends on data. It depends on pricing. It depends on trust. It depends on capital. It depends on regulation. And it depends on whether insurers can understand the risk well enough to put a price on it. And that is where the problem begins. Insurance works best when losses are uncertain for each individual, but predictable across the group. But what happens when the group itself becomes harder to predict? What happens when storms are more damaging? When floods reach places people thought were safe? When repair costs rise? When cars become more expensive to fix? When healthcare becomes more expensive? When cyber risk spreads faster than old risk models can follow? When courts, regulation, and customer expectations change the cost of claims? Then insurance becomes harder to price. And when insurance becomes harder to price, one of three things usually happens. The premium goes up, the coverage becomes narrower, or the insurer pulls back. That is the quiet mechanics behind a much bigger social question. What can still be protected? What becomes too expensive to protect? And who carries the loss when protection is not there? That question is now appearing in different forms around the world. Why risk is being repriced. Insurance is getting harder not because one thing changed. It is getting harder because several systems are moving at the same time. First, physical risk is changing. Floods, storms, wildfires, heat, drought, and severe weather are affecting homes, businesses, farms, roads, energy systems, and supply chains. This does not mean every place faces the same risk, but it does mean the old maps are being questioned. Second, the cost of repair has changed. A damaged car is no longer just metal and glass. It may include sensors, cameras, software, batteries, and advanced parts. A damaged home may cost more to rebuild because materials, labor, and building standards are more expensive. A damaged business may lose not only stock but data, customers, and operating time. Third, risk is becoming more connected. A flood can affect property, but it can also affect transport, supply chains, electricity, loans, rent, jobs, and government spending. A cyber attack can affect one company, but it can also affect customers, suppliers, banks, and insurers. Fourth, data is becoming more precise. Insurers can increasingly see where risk is concentrated. That can make pricing more accurate, but it can also make insurance feel less fair. If your home, car, health, business, or location is now classified as higher risk, the system may charge more, exclude more, or ask more questions. And fifth, reinsurance matters. Reinsurance is the insurance behind insurance. It is what insurers buy to protect themselves from very large losses. When reinsurers charge more, reduce appetite, or change terms, that pressure can move through the system. Eventually, it can reach households and businesses. So when someone asks why their insurance has become more expensive, the answer may not be one event. It may be a chain. Higher claims, higher repair costs, higher uncertainty, higher capital cost, higher reinsurance cost, more precise data, more selective underwriting, and more pressure on what the insurer is willing to cover. The United States shows what happens when insurance becomes a housing issue. In the United States, insurance is increasingly connected to the future of housing. This is not only about one state, it is not only about one wildfire, one hurricane, or one flood. The deeper issue is that homes need insurance because mortgages need confidence. If a house is damaged and cannot be rebuilt, the homeowner suffers. But so does the lender, so does the neighborhood, so does the local tax base, so does the wider housing system. That is why homeowners insurance is not just a personal product. It is part of the architecture of housing finance. In areas exposed to wildfire, hurricane, flood, or severe storm risk, the pressure can become visible quickly. Premiums rise, deductibles increase, coverage becomes more limited. Some insurers reduce exposure, some homeowners struggle to find affordable protection. And when insurance becomes more expensive, the cost of owning a home rises. A mortgage payment is not the whole cost of housing. Insurance is part of the cost. Taxes are part of the cost. Repairs are part of the cost. Energy is part of the cost. And when all of these rise together, the pressure on households becomes much heavier. This is why insurance can become a cost of living issue. It is also why it can become a mobility issue. If a family cannot insure a home affordably, can they buy it? If they already own it, can they keep it? If they want to sell it, will the next buyer be able to get insurance? And if the private market pulls back, who steps in? The state, a public insurance program, the taxpayer, the household itself. The United States shows one of the clearest lessons in the global insurance story. When risk rises, the price of protection can become part of the price of housing. When risk rises, the price of protection can become part of the price of housing. And when the price of housing changes, the effect does not stay inside insurance. It moves through families, banks, property markets, and public policy. But this is not only an American story. Europe is facing its own version. The United States shows one of the clearest lessons in the global insurance story. When risk rises, the price of protection can become part of the price of housing. And when the price of housing changes, the effect does not stay inside insurance. It moves through families, banks, property markets, and public policy. But this is only one version of the story. In Europe, the pressure appears through storms, floods, and natural hazard protection. In the UK, it appears in household premiums, flood claims, car repairs, and storm damage. In Germany, it appears in the protection gap around heavy rain, flooding, and natural hazards. And in Asia, the story is different again. There, the issue is not only whether insurance is becoming more expensive, it is whether enough of the risk was insured in the first place. In India, more people are building wealth, buying vehicles, homes, healthcare, and financial products. But as assets grow, the need for protection grows with them. And in Singapore, a dense, high-value, and globally connected city, insurance is part of a wider resilient system. Property, health, travel, cyber, climate, business continuity, and financial confidence. So the global question is not simply, why are premiums rising? The deeper question is, when insurance becomes expensive, narrow, or unavailable, who pays? Because the risk does not disappear. It moves to households, to banks, to landlords, to employers, to governments, or to people who did not realize they were carrying it. That is where the next part begins. Who pays when insurance stops working? This is Lessons Untold, understanding the forces that shape our world. Subscribe for Part 2.